Okay, folks. I don't think you need the reminder that if you don't pick up your quizzes within 10 minutes of this class ending, I have to take them back into my office because I've leave them out there during the break. God only knows what will happen to them by the time we get back. So if you don't want your quizzes, I frankly don't care, right? I know some of you are in denial where if you don't pick up your quiz, it's like Schrodinger's cat or whatever that thing is. If you don't pick it up, it doesn't exist. It does exist. The grade's been recorded. It's not going away. The reason I wanted to pick up your quiz is to make sure I haven't screwed up on your grade. It's purely from your perspective. But if you don't pick it up by 5:15 today, I will bring it into my office. And if you really want it, come back after the break and you come and I have to ask for it in my office. Now, the reminder, I know that you're planning great things for your break, budget constrained, of course. No. So you're not planning to work on your valuation. But if any of you are left desolate and alone in New York and you have nothing to do, I have something for you to do. Take the spreadsheet, do the valuation, get it done with. Because when you get back 10 days later is your feedback day, right? That's the point in time at which, and I'm not, just turn in your spreadsheet. That's all you need to turn in is turn in your spreadsheet. I'm not expecting, because it's purely for feedback. But I need that by, I think, March 31st, that Friday, whatever. I think it is definitely March 31st. So that's the date. So so what I'm trying to say is if you haven't picked a company, what are you waiting for? If you picked a company and you haven't entered it into the master list, what are you waiting for? If you picked a company and entered the master list and you haven't picked up the financials for your company, what are you waiting for? No, so get at least a start of the process going. So today we're going to keep going with the loose ends. Remember, we talked about cash. Today we're going to talk about more stuff. So let's start with the first question. One of the things I'm going to ask you about is complexity. Some companies are easier to value than other companies, and I'm going to present some examples as to what creates complexity. But I'm going to give you two companies, company A, company B. First company is in a single business, very easy to understand. Everything is transparent. Company B is in multiple businesses, and there's opaque financials. You know what opaque financials is? The annual report claims to be in English, but you read it, you don't understand a single word of what they're saying. It's written by lawyers, for lawyers, so you read it and you're completely confused. So a simple company, complex company, as an investor, assuming their numbers look similar, which of these two companies would you value more highly? The simple company, the complex company, and tell me why. Anybody? You'd pick the more complex company? Anybody want to go along with complex or pick simple? Why would you pick the complex company? So you're saying there could be potentially more risk, but remember that's already valued in. Presumably you built it in. So remember, you could create something like company B by buying 5 companies in different businesses, right? You can create your own complexity in your portfolio. The question is, do you want it in one company or do you want it in 5 different companies? Yeah.
Probably neither. They'll have the same value. You just are more likely to stay the company.
Okay, let's back up. What is it about company B that's a little scary? There's a lot you don't know, right? I'll give away what traditional valuation does and why I think we make a mistake. In traditional valuation, we make the assumption that what you don't know can't hurt you. It averages up. It's an averaging. You take 100 companies, you don't know much about any of them. There's an advantage of the law of large numbers. Ignorance averages up. But there's a problem with that assumption. When you have a complex company and managers are not telling you much about the company, what are they holding back on? Good news or bad news? Or let me phrase it differently. When was the last time you woke up to an accounting scandal where the company said, guys, we made 5 times more money than we told you? You had a scandal like that? Almost always a scandal is on the downside. When you get surprises in these companies, it's almost always a negative surprise. I'm going to give you the time when I started thinking seriously about complexity and what triggered it and how I approach complexity today as part of it. But I wanted to start thinking with some of your companies are easier to value than others. You look across your group and say, I wish I'd picked that company. Because you look at your company, it's a mess. It's got 17 different kinds of bonds. It has 15 cross holdings. But some companies are just more difficult to value, more complex than others. Let's keep moving. Let's suppose you value a company. You come up with a value of 100 million by discounting free cash flows of firm at the cost of capital. The company has 1 bond outstanding or debt outstanding with a face value of 100 million, book value of 100 million. But the market value is only 80 million. So my question is a very simple one. Assume the value you did was right, 100 million for the assets. What is the value of your equity? Do you see the question I'm asking, right? Should you subtract out the 100 million, which is what you actually owe, in which case your equity is worth nothing? Or should you subtract out the 80 million, which is the market value of the debt, in which case your equity is worth 20 million? If you opened up my textbook and got to that section, you know what I'm going to tell you to do, right? I'm going to ask you to subtract that market value and tell you the value of equity is 20 million. The danger though is when I take a $100 million debt and give it a value of 80 million, it's because I think I see more distress, more chance you will not make it. If that disappears, 80 million is going to go to 100 million. The value of your equity is going to be nothing. If somebody acquires this company almost overnight, the value of equity is going to go to 0 because if the acquirer has a good credit standing, that discount will disappear. It's one of those cases where we use market value of debt all the time to get to value of equity. But I'm saying if you have a company which is in distress, you're subtracting out market value of debt. There is a very real danger in doing that because that market value of debt is discounted from the face value. You buy Bed Bath & Beyond, you take the debt at market value. It's going to be 25% of the book value. Treating the difference as the value of equity it's kind of, we do it all the time. I'll tell you the assumption, I'll come in and fill in the assumptions we're making, but it does make me uncomfortable when I have a distressed company to be subtracting out the market value of debt. So again, an issue we'll come back to as a loose end. So let's close up this process. It says 200 million, should be 20 million. No, nobody would ever attach a $200 million value. Actually, the last thing was management options. Over the last 30 years, increasingly companies have turned to giving managers stock-based compensation. Remind me again why companies give stock-based compensation. Right. I mean, 30 years ago, managers got paid in cash and bonuses. And over the last 30 years, there's been a shift in management options, restricted stock. Why do companies use?
Like tie the performance.
One is incentives, right? Which is a noble reason, but there's a much more prosaic reason. You go to work for a young tech company. Why do they have to pay you in options for restricted stock? They don't have the cash. Let's be completely honest, right? And this is going to become the basis for what we think about when we think about what should we do with options. I mean, incentives are a good thing, but the reality is many companies are using stock and options because they don't have the cash to pay their employees. It's management compensation. And that's going to frame how we think about dealing with those options. But let me take a much simpler example. Let's suppose you have 100 million shares outstanding and you value the equity in a company at $1 billion. Value per share is going to be $10 per share, right? Billion divided by 100 million. And let's say, well, you know what? I forgot to tell you something. This company has just Sorry about that. This company has just granted 10 million options to its CEO, and they're at the money options. You know what I mean by at the money option? The strike price is set equal to the $10. I have a very simple question about what the effect will be on your value per share. Before I told you this, what did your value per share at? $10 per share. Now I've issued 10 million options that are at the money. Is your value per share going to be unaffected? Is it going to go up or is it going to go down? They're at the money options, right? So until the late 90s, you know what accountants did with at the money options? They said if they're at the money, they're worth nothing. It's absurd, but that's what they said. If you're giving away something worth nothing, it'll have no effect on your value per share. But as equity investors, are you worse off now or better off than you were before? In other words, the 10 million options, are they free just because they're at the money? What's the essence of an option? Is you get the right to buy shares at $10. If you exercise the option today, it's right. You're right. There's no effect. But no management is going to exercise the option today, right? What are they going to do? They're going to sit on the option. If the stock price goes to 25, they're going to exercise the option, in which case you're selling your shares at a discount to those people. That's what an option pricing model is designed to capture. And at the money option is not worth nothing. So today we're going to talk about how to deal with options outstanding. And you can't just adjust the number of shares or treat them based on exercise value, which is what a lot of people do. You have to think about the value of options. So lots on our agenda. Let's go back to where I left you, which was, I think we were talking about closed-end funds. The point I left you with was closed-end funds, where essentially all your assets are tradable securities with the market price that they typically trade at a discount of around 15%, maybe even 20% on their value. I want somebody to tell me why closed-end funds, why you discount closed-end funds, what's driving it? And to give you some background, if you look to the right, I've given you some facts about closed-end funds. When you invest in a closed-end fund, you have an expected return based on the riskiness of the stocks invested in, tech fund, and index fund. Let's say that required return is 11.5%. Let's suppose you have a closed-end fund that consistently delivers 0.5% less than that expected return. Why might that happen? Why would you be delivering 0.5% less? Let's say you pick stocks, but you're not very good at picking stocks. You just randomly pick stocks. You should make 11.5%, right? So where's the 0.5% going? It's going into analysts. So if you go to work for that closed-end fund, I have to pay you. I pay you bonuses. I have big buildings. I fill the buildings up with people who are basically doing nothing other than sucking up value. But if you have a fund that consistently delivers less than what it needs to deliver, remember with cash, we said if you don't make your required return, I'm going to discount cash. You're going to see the same kind of discount with closed-end funds. So here's the implication. If I gave you 100 closed-end funds and I gave you the history of returns, I would expect closed-end funds that do the worst, that have performed the worst, to be discounted more than closed-end funds that do much better. And you know, 20% of closed-end funds actually trade at a premium. Why? Because you earn more than your required return, because you got a great manager who picks great stocks. Guess what you're going to do? You're going to take the value of the fund, add a premium on, not because you think the assets are worth more, but because you're paying a premium for the manager. I'm going to show you the most famous closed-end fund in history. You don't think of it as a closed-end fund. It's a company called Berkshire Hathaway. What's Berkshire Hathaway's core business? Where did they get the capital to invest? You see the Gecko ads, right? The Geico is the insurance company. Berkshire Hathaway owns it. It is an incredibly well-run insurance company. But if you think about an insurance company, what do insurance companies do? They sell insurance policies. They collect premiums. Those premiums get invested in shares or stock or whatever they want to invest in. In a typical insurance company, basically, you got an insurance business and a closed-end fund. Because the insurance business is how good are you at assessing risk and charging premiums. The closed-end fund is how well are you managing that money. Typical insurance company, you really don't get a premium on the closed-end fund side because you have an average manager. So you judge if you're Allstate or State Farm and how good is your insurance business. But Berkshire Hathaway is different, right? You're an insurance company with a closed-end fund run by the most well-regarded fund manager in history. You know how this manifested itself? What do we say about closed-end funds that deliver more than the expected return? They trade at a premium. And if you look at Berkshire Hathaway, relative to other insurance companies, the way this showed up is the price to book ratio for an insurance company. And remember, for insurance companies, book value is actually mark to market. So it's basically the market value of holding. You used to trade at 3.5, 4 times book value. The way I used to describe this in the late 90s when I talked about Berkshire Hathaway is if you like Coca-Cola as a company and you want to buy it, you could pay a price, the market price. But if you bought Coca-Cola, Berkshire Hathaway has been one of the largest shareholders in Coca-Cola. If you bought Berkshire Hathaway, you were buying Coca-Cola at 4 times the market price because of the Buffett premium. That was in the late 90s. Berkshire Hathaway was special. That specialness seems to have faded. If you look at this graph, you can see the price to book ratio has drifted down. Today, Berkshire Hathaway trades at roughly the same price to book ratio. In fact, a little bit of a discount on a typical insurance company. The Buffett premium seems to have disappeared. Why? Why is there no Buffett premium left anymore in Berkshire Hathaway? Anybody want to try? They can try, right? Who's beating the market? What other insurance companies? Because you need to beat the market, right? It's one of the toughest things to do is to beat the market consistently. Warren Buffett earned that reputation the hard way. He's getting old. We don't have to look far. How old is he? 91 years old. I'm not giving you a secret. He is going to die one of these days. I'm not being morbid, just like we all are. And the market knows it. You got a 97-year-old in Charlie Munger and a 91-year-old. You know that this is not going to be for much longer. And we've known that for a while. In fact, 10 years ago, Warren Buffett told the world that he was passing the baton. You know, the 10 years ago, he picked these successors, Todd Combs, well regarded, when he said, I'm not going to be doing day-to-day stock picking. I'm going to let these 2 guys, there were 2 guys. So I'm not being sexist here, pick stocks for them. You've ever heard from them? It's still Buffett and Munger, right? The reality is this is not something you can pass on to somebody else, no matter who you are. The Buffett premium is fading because he's getting older. To be expected. There are other forces that are affecting value investing, but that's at the core of the disappearance of the premium. So when you look at Berkshire Hathaway, if you get a chance, think of it that way. As an insurance company with a closed-end fund, it kind of changes your perspective on what the company has to do to kind of get back its glory. So today, I know one of the things that people complain about is Berkshire Hathaway has a lot of cash. It doesn't seem to be investing the cash. Hey, you know what? Maybe you don't want them to invest the cash. It's a very average company in terms of what it earns in returns. And maybe the best thing to do is not push the envelope and try to do things just because you think you can deliver returns the way you used to. So that's cash. Any questions on cash or closely held companies? Let's move on to the second loose end. Talk about cross holdings. First step in understanding cross holdings is understanding how accountants deal with cross holdings, and it's a mess. There are 3 ways in which cross holdings can be classified. The first, you own 3, 4, 5% of a company, and you take no role in how that company is run. It's called a minority passive investment. In the second, you own 15% of a company. You have a director on the board. You have some say in how the company is run. It's called a minority active investment. And if you own 60% of a company, it's called a majority investment. So let's look at how the accounting works with each of these. If you have a minority passive investment, the 3, 4, 5%, no say in how the company is run, here's what you're required to report. In your income statement, you have to show the dividends you receive on that holding. Let me repeat that again. You show the dividends you receive. And on your balance sheet, you have to show what you originally invested to get the 3 or 4 or 5%. I'll give you an example of how disconnected the numbers you're going to see in the financial statements will be from reality. There was a version of SoftBank from way back in time, the late 90s, where at one point in time, I think in 97 and 98, half of SoftBank's value came from one holding it had as a company. It was an investment they made in another company called Yahoo that had taken off and become a $100 billion company. So SoftBank's holding in Yahoo was worth about $7 billion, and half the value of SoftBank as a company. Let's say you're an analyst looking at SoftBank's income statement. It was classified as a minority passive investment. What would you have seen from that Yahoo holding? What did it say? You have to report dividends on the holding, right? You know what dividends Yahoo paid in the 1990s? Nothing. You'd have seen nothing. You say, that's okay. I'll go look in the balance sheet. In the balance sheet, you've seen a $50 million value for the Yahoo holding. Completely disconnected from the $7 billion because they were reporting what they originally invested as venture capitalists. Minority passive investments, what you see in the financials will bear no resemblance to reality because of the way it's accounted. Then you get to minority active investments, 15% of another company. You have to use what's called the equity approach. What's the equity approach? In your income statement, you have to show 15% of the net income or net loss from the better than dividends. At least you're translating that through. And in your balance sheet, you have to show what you originally invested plus or minus 15% of the retained earnings set. So it's like an updated book value. Better, right? And then you get to a 60% holding, accountants flip out. What are you required to do with both IFRS and GAAP when you own 60% of another company? Consolidate. And I've never understood the logic of this. Help me out here. So when I do my income statement, I look at revenues and consolidation. What am I required to show? 100% of the subsidiary's revenues. And you tell the accountant I own only 60%. The accountant says, don't worry about it. Get the operating income. I count 100% of the operating income and say, own 60%. Don't worry about it. I get to the balance sheet. I count 100% of the cash. I own only 60%. The accountant says, don't worry about it. Then at the end of the process, he wakes up and says, you own only 60%. You say, what do you think I've been trying to tell you all this time? You don't own 40%? Duh. We have to show the 40% that doesn't belong to you because it doesn't belong to you. So you know what ends up happening on your balance sheet? Because you acted like you owned 100% of a subsidiary, they own only 60% of you. To show the 40% that doesn't belong to you. First, on which side of the balance sheet? Asset or liabilities? Sure, it's a liability because you counted 100%. You call it minority interest or non-consolidated. They give it a fancy name. You have no idea what it is, but there it is, big item on the other side. It's a residue of consolidation. And now we've added layers to this. When you have a joint venture, some joint ventures qualify what's called proportional consolidation, which means you count only the 55% that's your share of the joint venture. If you hold something for trading, you have to mark to market. So some cross holdings are mark to market. So SoftBank now is covered by rules where every quarter they have to mark to market. What I'm trying to say in a long-winded way is if you have a company with lots of cross holdings, the first thing to understand is the accounting of those cross holdings. And it's not easy. I've had companies where this has been my biggest roadblock is figuring out how a company is recording cross holdings because without knowing it, I don't even know what to do with those numbers. So let's talk about how you would value cross holdings in a perfect world. In a world where you could ask for whatever you wanted, here's how I'd value cross holdings. I'd first value the company that has the cross holdings, just the parent company part. I'll give it the growth, cash flows, risk that reflects the parent company. Then I take each cross holding in the company and value it separately with its own cash flows, growth, and risk. So if I have a US company with a Japanese subsidiary, I can value the US company in dollars, the Japanese company in yen, I get complete flexibility. I don't care whether it's a minority holding or a majority holding, because in the end, here's what I do. I take the parent company value, and then I take 10% of company A and 15% of company B and 60% of company C. I add them all together, and I've got an intrinsic value of a company with its cross holdings. Sounds messy, right? So I'm going to give you an example. So from 2013 or 2014, I valued Yahoo. Yahoo in 2014 had just, they had a new CEO, and Marissa Mayer. She'd come over from Google, great reputation, was going to turn the company around. And I valued the company in three parts. First, I took Yahoo as an operating company. And Yahoo is an operating company and not much to show, right? Search engine that had faded, Google had dominated the business. I came up with the value, pretty generous valuation of about 7.4 billion for Yahoo, the parent company. This is just the search engine, the email, the traditional Yahoo. The bulk of Yahoo's value, though, came from two cross holdings. One was a 35% share of Yahoo Japan, which was a standalone publicly traded company. The Japanese still seemed to like Yahoo for whatever reason. So I valued Yahoo Japan, again, an intrinsic valuation, and I came up with a value of equity by looking at the 35% of that intrinsic value. You know, the other cross holding was? It was a 22% stake in Alibaba. This was right as they had filed a prospectus for their IPO. So I valued Alibaba as a standalone company with its own cash flows, growth, and risk, and took 22% of that. They'd filed that. I used, this is why I had to wait for the prospectus to be filed. This was done at the time they filed the prospectus to go public. In fact, I'm glad you brought that up. Until they did that, I wouldn't have been able to do an intrinsic valuation of Alibaba. So once a prospectus got filed, I was able to get my hands on the numbers. But that's part of the reason I had to wait, because if I'd done this before, I'd have had to use some estimates of revenues to make a pricing of Alibaba. But the prospectus was what triggered my being able to complete this.
Didn't they go public in like 2014?
This was actually towards the middle of 2014. I don't know what the right. So it was actually I know the timing of this particular valuation was right after the prospectus came out, before they actually went to the market. They actually went public at about 200 billion. So my estimate of intrinsic value reflected what I saw in the prospectus. But basically, I did intrinsic valuations of all three pieces. But think of what I allowed me to do it. I had full financial statements for all three companies because I had the prospectus for Alibaba. Yahoo Japan was a standalone company. Yahoo gave me parent company numbers. I was able to value three companies because I was given the financials. That's not always the case, right? If you think about the challenges you face, often you're valuing companies with incomplete information. I'll tell you a story to kind of illustrate how incomplete. In the late 90s, I was valuing a Japanese company for one of my valuation books. And Japanese companies in the late 90s are always teetering on the edge of disaster because the risk-free rate in Japanese yen was so much lower than the risk-free rate elsewhere in the world. You had to be careful about what growth rates used in perpetuity. I was careful. I finished my valuation. I'm patting myself on the back. Then I look at the financials for this Japanese company, and they tell me that they have 227 cross holdings. My stomach drops. Because if I'm a careful analyst doing intrinsic valuation, you know what I should do next, right? I should value 227 other companies from scratch. I'm way too lazy to do that. But let's say I'm not as lazy as I actually am, and that I say, okay, I'm going to value 227 other companies. I wouldn't have been able to do it for a very simple reason. 60 of these companies were public, so I could get the financials. The remaining 167 were private businesses with zero information provided. So I called the investment relations officer of this Japanese company. She's a very polite lady. And I said, look, I'm valuing a company. It's not for an expose. I need some information in your cross holdings. She said, I cannot give you that information. I said, why not? She said, it's proprietary. The way she said proprietary was kind of scary. It was a little intimidating, but I said, okay, what if I bought 1,000 shares in your company and called you that? She said, still be proprietary. I said, that's weird. If I own 1,000 shares of your company, I'm part owner of the company, you're refusing to tell me what I own. She thinks for a few seconds that you have a point, but it is still proprietary. At this point, I'm banging my head against a brick wall. I get ready to hang up the phone. And she says, wait, I do have some information I can give you about these subsidiaries. I said, okay, expecting some revenues or operating income. I said, what? And she said, I can't give you details, but they're worth a lot. I said, I'm sitting here with an Excel spreadsheet. I'm trying to enter an LOT into this cell, and I keep getting error messages below. How many zeros are there in a lot? But it kind of cuts to the heart of the cross-holding culture, right? What do managers do? They hold up a brown paper bag and say, trust me, it's full of cash. Can I look at the bag? No, no, trust me, it's full of cash. I'll tell you exactly how much cash. And that's exactly what we do with these companies because we let them tell us what their cross holdings are worth. We treat that number as the value of the cross holdings. Why would they ever let us look in the bag? So the challenge you often face in practice is you don't have the numbers to do an intrinsic valuation, or just too many companies. I mean, let's face it, even if I had the financials, do you really want to value 227 companies to decide whether to buy one company? I don't. So I'm going to give you some shortcuts you can use. Let's say with the Japanese company. I told you 60 of these companies were publicly traded, right? So what's one way I can cheat to come up with the value for these companies? They're publicly traded. There's a market price. I know it's cheating. Why? Because I'm taking a pricing and adding on to intrinsic value. But you know what? When you're lazy, those things kind of slip by. So I can compromise. Think of how much time it's going to take me to value 60 companies, or the compromise, I'll take the compromise. On the remaining 167 companies, what do you have? You have a book value for each of these companies. What if I could tell you what the typical price? So let's say one of your companies is a chemical company. You tell me my book value is 10 million. And I tell you a typical chemical company trades at 1.5 times book value. You see the cheating game there. You take the 10 million book value, apply 1.5 as a multiple. Isn't it my estimated? I know it's shoddy. But when you have dozens and dozens of cross holdings, rather than value each of them, often you take that practice. So you want to see a pricing of Yahoo? Much less done. So here's what I did. I took the 3 pieces, and rather than try to do an intrinsic valuation of each, I priced each one. We haven't got to the pricing stage, but I'll keep it simple. I used an EV to sales ratio, multiple of revenues, and I priced Yahoo, the parent company, priced Yahoo Japan, and priced Alibaba. Then I brought those numbers together to come up with the pricing. You think, what's this taxes? One of the conditions that Alibaba put on Yahoo as part of their IPO is that after their IPO, Yahoo had to divest itself. I think of 8% out of the 22%, it was a requirement. The problem is when you divest it, when you sell it, you have a capital gains tax that's going to come to you. That's what I'm trying to estimate the taxes to. So often the shortcut of pricing a subsidiary is something we adopt because we don't have the information. We're in a hurry. We have too many cross holdings. And if you have a company with lots of cross holdings, unless you're one of those companies, the cross holding is 80% of your company's value, the shortcut might do a pretty good job of taking care of those cross holdings so you can move on. So that's the cross holding. And as I said, it's not easy. I'll tell you, on quiz 2, this is going to be the problem that always gives people trouble because they don't know what to add, what to subtract. So start wrestling with the accounting for cross holding because it's something that you will find yourself struggling with because of the nature in which the accounting is done. So you value cash, you value cross holdings, and then you look and say, is there something I've missed? And this is where you make the mistake of looking at the balance sheet. You say, why is that a mistake? Because you start seeing this, and maybe I should add that. How about goodwill? Maybe I'll add that on. Or they own physical assets, I'll add that on. Your real estate. So I'm going to state a rule that I hope you never violate. You can't double count an asset. So if you're a hotel company and I do a discounted cash flow valuation of you as a hotel business, where I look at your revenues, you know what you can't do? You can't add the value of the real estate that you sit on to your discounted cash flow valuation. Why not? Because that real estate is what's generating the cash flows. You can't count the cash flows on an asset and the value of the real estate it sits on. So if you value JP Morgan with the dividend discount model, you can't add the value of 285 Park or 277 Park or whatever other buildings they have to your valuation, because those are the buildings that your traders and your bankers sit in that generate the cash flows that give you your dividends. So what are you looking for? You're looking for truly vacant assets. What's a vacant asset? Something with value, but is contributing nothing to the operating. Think, what kind of asset would that be? I'll tell you a story, and it'll bring home what I mean by a vacant asset. You heard of the Michael Price Fund? Michael Price Fund is a fund that was founded by Michael Price, who 20 years ago sold his mutual fund to the Japanese. He sold for $250 million. He had a lot of money, and when NYU knows you have a lot of money, especially with Stern, they notice you have a lot of money, then come and ask you for money. I've never been part of the process. I hate asking for money, and why would I want to bring money into a university where I know how much is going to get wasted? But in this case, I made an exception, and then I said, can you go talk to Michael Price? Because they wanted to create a fund that MBAs could manage. That's a Michael Price fund. So I think the original seed money for the fund was $10 million. So it's run by a group of MBAs. It rotates every year, obviously, because people graduate and new people come in. I've had zero official role in this fund. But almost everybody who goes to the fund has gone through one of my valuation classes. And the way the fund works is you pitch a stock to the other people who run the fund, and they decide whether to buy the stock or not. So guess who they come and try the pitch on first? I unfortunately end up being, oh, can I try the pitch on you? And I say, okay, let's. So this is about 15 years ago. One of the people running the fund comes in, and he says, I'm facing a conundrum. Very quickly, I had to turn to my computer, type in the word conundrum, and it turns out he was confused. But I like the word. I said, what's your conundrum? He said, I'm valuing Playboy. I said, I don't see a conundrum yet. He said, I valued it at 240 million. It's priced at 300 million. I said, I still don't see a conundrum. I like the word so much, I was going to use it every year. You don't buy the company. He said, here's my conundrum. There's one asset that Playboy has that's very valuable that I haven't included in my 240 million. What do you think he was talking about? So don't think bunnies, they're already in the cash flows. Okay? Don't think magazine, it's already in the cash flows. You know what he was talking about? The mansion, Playboy Mansion, is one of the most valuable properties in LA. And it's owned by the company. And here was the problem. At that time, he estimated the value of the mansion to be about 150 million. The question he was asking is, can I add the 150 million on to the 240 million, in which case the company looks undervalued? I said, yes, but you have a problem. There's an 81-year-old in a bathrobe hanging out in that mansion that you can't exactly throw out onto the street, right? Because you know who was living in the mansion? Hugh Hefner was still there. So he said, what should I do? I said, check the actuarial tables. So what am I checking for? Check to see how long 81-year-olds who surround themselves with 26-year-old playmates tend to live. Not that long. Let's say 5 years, right? 7 years, make a judgment. It's not going to be 500 years. It's not going to be 15 years. And then he said, what should I do? This guy needed guidance all the way through. He said, take the value of the land, discount it back 7 years. You want to get fancy and use a caustic capital for real estate companies, be my guest, but then add it onto the 240 million. That's a vacant asset, something you haven't counted. I forgot all about this, but a few years later, I wake up to a story in the Wall Street Journal. And Playboy managed to have its cake and eat it too. Here's what it did. Sold the mansion to a Greek billionaire with Hugh Hefner in it. I'm not kidding you. The guy bought the mansion on the contingency that Hugh Hefner could live out the remaining years in the mansion. So why would he do that? Reflected glory or whatever reflection you get out of the Playboy mansion. They actually sold it for $200 million. That is what a vacant asset looks like. It's not physical land that you already have a factory on. It's something that has value that you haven't counted in your operating assets that you're bringing in. And that's not double counting. But I'm going to present you with, go back to the hotel example, because around the world, especially five-star hotels, expensive, are facing a conundrum. Let's use that one last time. To see what that conundrum is, here's what they're facing. And I want you to think about it. Let's say that I take the Ritz-Carlton or the Waldorf Astoria, storied names, and I value them as hotels. Let's take the Waldorf Astoria. Let's say I value it as a hotel. What does that mean? I project out occupancy rates of the hotel, charge a price, take the present value. Let's say I come up with 600 million. And then I look at the value of the real estate that that hotel is sitting on, and I come up with the value of $1 billion. Which one should I use as my estimate of intrinsic value? The 600 million or the billion? Let's say you think about investing in, it's a traded company. You got 600 million as a hotel company, $1 billion as real estate. Which one should I use as my intrinsic value estimate? The lower of the two, the higher of the two, and some average of the two? Or will it depend on what my role is as an investor? First, if I take the higher of the two numbers, say, look, the real estate is worth $1 billion, what's my biggest risk? I buy the company and it stays a hotel, right? It's worth only 600 million. If I leave it at 600 million, there are going to be people outbid me because the real estate is worth more. What did the Plaza do though? Plaza used to be a hotel, New York City, 59th Street. They converted themselves into an apartment building. And because one of the things that does happen at some point in time is real estate becomes more valuable, you're going to switch away from being a hotel company. The other is that, especially at peak real estate prices, you get what's called a sale and lease back. You sell the real estate, you collect the high price, and then you lease it back, hopefully at some discount rate, and you continue to run as a hotel. Around the world, this is becoming an issue. A lot of companies that sit on very valuable real estate are worth more as real estate than they are as operating companies. And it's in Asia, this is out of control because you take real estate in Bangkok and Mumbai, and you look at how much it's gone up. It's very difficult to justify running a hotel company on that real estate. It's just worth too much. So we talked about cash, cross holdings, other assets. Let's talk about complexity. I'm going to present you with two companies. Now, company A, company B, again, not particularly creative names. Company A is simple, company B is complex. And we already talked about why you want to buy the simple company, because there's so much in the complex company you don't know that when you get a surprise, it's more likely to be a negative surprise. I'll be quite honest, first 15 years I taught valuation, I didn't think seriously about it. Then in the late 90s, there was a company called Tyco that had an accounting scandal and ended up losing almost 80% of its value. I'll tell you what Tyco was. Tyco was a conglomerate that grew through acquisitions. And in the process of doing acquisition, they hit a lot of bad stuff and it all blew up and took the company down. But that's not the story. As Tyco's stock price dropped 80%, GE lost 15% of its value. You're saying, what's one got to do with the other? How did I describe Tyco? A conglomerate that grew through acquisitions, and it used the acquisition process to hide a lot of bad stuff. What was GE in the late 90s? A conglomerate that had grown through acquisitions. You can see already as an investor, you're saying, I got burnt with Tyco. How do I know GE is not doing the same thing? It doesn't sound fair, but that's how investors adjust. I was actually teaching a valuation class, which is pretty much every year, unless it's sabbatical, I'm doing it. So during the class, somebody said, well, now should we be, we have a company like Tyco, should we be discounting the value for this kind of bad stuff that could happen? And I said, well, probably. And then I said, there are two questions we need to address if we want to bring complexity into value. If we want to say complex companies are worth less than simpler companies because we worry about this downside risk. First, we need to measure complexity. We can't say, I'll know it when I see it. You have to come up with a measure of complexity. And second, we have to figure out how to bring that measure into our cash. Remember, ultimately, we have only a certain number of tools to move at. You can adjust the cash flows, you can adjust the discount rate, you can adjust the length of the growth period. They all agree. They said, well, how should we measure complexity? They said, you're teaching the class. Why don't you come up with the measure? It's your job. I said, okay. I came back the next class with my first measure of complexity, and they weren't impressed. Here's what I did. I counted the number of pages in the 10Q and the 10K. I know it's incredibly simplistic, but play along with me. If you wanted to avoid valuing one company in this group, which company are you not going to want to value? The heck is this? 1,026 pages. This isn't War and Peace. This is how many pages it took Citigroup to tell me what happened in 1 year. It takes you 1,000 pages plus to tell me what happened last year. You're one heck of a screwed up company. So I present this. The MBAs were not impressed. They said, we're not paying $200,000 or $150,000 to count pages in a 10K. We'd like something more sophisticated. I said, you're right. What was I thinking? I'll be back next class. I came back next class with what I call my valuation shit list. My technical term. It's all the things that bug me when I value a company and how much they bug me. I made it into a spreadsheet. I'll give you examples of things that bug me. A company that claims to be geographically diversified but doesn't tell you where. Or they break down their revenues by geography but don't recognize any of the geographies. It's like, Lord of the Rings universe. It's not any universe that I'm familiar with. I remember the first time I valued BMW. break the revenues down, or North America, South America, Oceania. Where's Oceania? Turns out to be Australia, New Zealand, and Indonesia, but you can see if you bundle them together. So these are things that bug me. Tax rates that move wildly, deferred taxes that go from asset to liability. So I built a spreadsheet where I said, you know what, I'll come up with a way of coming up with a score. Basically, I'll go through. And the higher the score, the more complex you're as a company. So I come back to my class and they said, do you like this more? And this is exactly why we come back for MBAs. This is so much better. I said, it comes with a consequence. To come up with a score for Citigroup, what do I need to do? Read 1,000 pages. And I said, I don't feel like doing it, but each of you is valuing a company this semester for your project, right? They could see the train coming at them down the tracks. Too late to get out of the way now. I said, this semester, in addition to valuing a company for your project, why don't you come up with a complexity score? It wasn't a question. It was an edict. They bitched and they moaned, but it's too late. They should have just picked the number of pages that I offered them the previous week. That semester, in addition to valuing companies, every person in the class had to come up with a complexity score. I'm glad I did it because we learned something about complexity that semester. First, I went into this process thinking that large companies would be more complex than small companies. And what I discovered, there was almost no correlation here. Small companies were complex and large companies that were not. Walmart, simple company to understand. Snowflake, incredibly messy company. Second, they found that emerging market companies were about 20 to 25% more complex than developed market companies, usually because of cross-holding structures. Pyramid structures, cross-holdings. They found that any company that grew through acquisitions was almost 40 times more complex than a company that grew with internal products. Some of you are struggling with companies that grow through acquisitions, and you're already seeing some of the issues, right? When you have acquisitions, your CapEx is lumpy. You do a big acquisition, you don't do one for 2 years. And it creates accounting debris, things like goodwill and writing off of restructuring. And finally, they found that any company with a financing arm embedded in it was incredibly more complex than a company without. You know what I'm talking about, right? GM, GMAC, Ford, Ford Capital, Volkswagen, Volkswagen Capital. Why? Because you put a bank in the middle of your company and said, hey, we have a Chinese wall around the bank, trust us. All the debt is in the bank. How do I know? And they also found that a significant amount of complexity was self-imposed. I mean, managers always say it's accounting standards, the country I'm in. It was by design. You're saying, why would I make my company more complex? What incentives do companies have to make themselves more complex? If you can't figure out what's going on in the company, you can't even ask any good questions, right? You're managing the company badly. I have no idea. You're doing it for control. You're doing it for the fact that people can't ask you questions. And essentially, it protects you as management. So that semester, the most complex company in the class that people came up with was GE. I tell people, look, if I'm the devil, I'm not planning to get to that position, but if I did make it, and my job was to deal with all the bankers who end up in hell, and there'll be quite a few, and I had to design a company to torture them, I would make it GE. And here's what you'd have to do. You'd have to value GE. It'll be like, over and over again, you'd have value GE for the rest of eternity. It's a nightmare for a company at its peak value. I'm not even talking about the GE of today, which is a walking. This was at its peak. I would look at the company and say, no, it's a company that terrified. 26 different businesses. You had GE Capital as one of the businesses, grew through acquisitions. It was almost like Jack Welch said, how can I make a company that's so incredibly difficult to understand that people will just give up? So think about complexity. And when you look at your company, you say, there's messy stuff in the company. Some of it is by design. It's there to obscure the truth. And your job is to get past and make your best estimate. So once you've measured complexity, the question is, what do I do about it? So let's cut down to basics. What are our choices? One is you can haircut the cash flows for complex companies. You know what that means? You get your expected cash flows and you knock off 10%. And therein lies the problem. Why 10%? Why not 15%? So you take complex companies. I've never tried that because I can't tell why it should be 10 and 20. The second is you can try to use higher discount rates for complex companies. You're saying, where would it show up? It's not in the risk-free rate, in the risk premium. Can I use a higher beta? It's tough to do. So here's what I did. Remember, this was one of the months I spent during my sabbatical on complexity. I took the S&P 500 and I broke it up into two groups of 250 companies. One group that I call 250 simpler companies and the other group 250 complex companies. A little bit of subjective judgment, but I made. Then I computed the implied cost of equity. Remember how I did the implied equity risk for the entire market? I did the implied cost of equity for the complex half and the implied cost of equity for the simple half. And at least at that time when I did it, the complex half of the S&P 500 the cost of equity about 1% higher than the simple half. If I wanted to extrapolate that for a complex company, I'm going to take risk-free rate plus beta times equity risk premium and add on an extra percentage for the fact that it's a complex company. But I'll give you my favorite device for dealing with complexity. We said the value of growth comes from earning excess returns, earning over and above the cost of capital. When you have a simple company and you see the company earning a 30% return on capital, let's take Amgen, great biotech company. It's fading, it's scaled up. It was earning 20% its return on capital 10 years ago. And you ask me, why is it earning a 20% return on capital above the cost of capital? I could give you a good reason. It's a pharmaceutical company, it's got patents, these are big blockbuster drugs. I understand where the returns on capital are coming. In contrast, if you have a complex company, you see them making money, but you have no idea where they're making money or how they're making money. Even if they're making a 20% return on capital, if I ask you, can they keep doing what they're doing? If you don't know what they're doing, how can you make that assumption? And going back in time, the late 90s, one of the companies people would pick for this class to value was Enron. That time, successful company, huge market cap. And to a person, every person who picked Enron to value would show up in my office and say, look, I see that this company is making a lot of money, but I have no idea what they do. Nobody could tell me. They traded energy. What does that even mean? Who do you buy it from? Who do you sell it from? Why do you make money on this? And they had all these special purpose entities. You had no idea what they did, but they threw out these huge profits. At that time, we didn't know about the underlying accounting scandals. But my response was, if you don't know how they're making money, you can't assume they can keep making it. You got to bring the return on capital down to the cost of capital very quickly, which will reduce your value as a company. And it sounded unfair that I was punishing a successful company, but with complex companies, sometimes the best way to deal with it is say, look, if I don't understand the company, I really can't tell a story, a sustainable story about them being able to continue to do what they're doing, and that's going to affect the value of your company. So if you have a complex company, pick your poison, decide how you're going to bring in that issue of complexity. Because it's cathartic, because this company has forced you to suffer for 3 weeks in the valuation. You get a chance to knock off that, it make you feel a lot better. Knock off a few $1 billion in value for making your life difficult for the last 3 weeks. But it's that adjustment for complexity. Just as a final throwaway, as the end of the month came about and was finishing up, so I wrote this paper on complexity that became a chapter in my book. I got to the last section and I took 100 largest market cap stocks in the US. And I ran a regression of price to book ratios against return, equity, beta, and growth, which are kind of 3 standard variables. And we'll talk about this more that you throw in to explain price to book. And then I threw in the number of pages in the 10K into the regression. First, I want you to look at this coefficient and give me an intuitive reading of what that tells me. Minus 0.003 times number of pages in my 10K. So I have 100 extra pages in my 10K. What happens to my price to book? It drops by 0.3. Imagine being a consultant at Citigroup. They say, look, our price to book is only 0.9. We'd like to double it. You know what they need to do, right? Knock off 300 pages of that 1,000-page 10K. It's easy. It sounds facetious. But remember, Citigroup ended up with a 1,000-page 10K by design. They did it because Citicorp, which was a bank, bought Travelers, which was an insurance company, and they decided they were going to make the largest financial service company in the world. It was going to be all things to all people. It was going to be a real estate broker with Caldwell. It was going to be an insurance company. It was going to be a bank. It was going to be a portfolio manager. Great ambitions, but sometimes in the process, you create this mess of a company that people look and say, I give up. I think money center banks are contaminated by this issue. Since 2008, people just don't trust money center banks. There's too many different businesses. Every 3 years, what do you have? You have a scandal. Some trader in London, Wales, Swan, whatever, lost $3 billion. It's almost built into the system when you build these complex companies. So complexity is something you're going to encounter in different levels in different companies, and you've got to figure out a mechanism for bringing that to your value. Let's talk about that. I'm going to give you two different rules for that. One is when you compute debt for cost of capital, which you have to do, right? You have to come up with a debt to use for the debt weight and the cost of capital. The other is the debt you will use to subtract out from enterprise value to get to value equity. On the first one, when you ask me what debt should I use for the cost of capital, my advice is stay narrow in your definition of debt. If you remember, I said use all interest-bearing debt, and least it should be treated as, no matter what the accountant says. So now that they've come around to my point of view, you're getting convergence, but all interest-bearing debt and leases. But stop there. Fight the urge to start adding other stuff into debt. The reason you have to fight the urge is you're trying to be conservative. And in accounting, conservative means counting everything in. Now, let's count underfunded pension obligations, underfunded healthcare obligations. The reason I want you to be cautious, if you add numbers to your debt, it makes your debt higher. It makes your debt ratio higher. But help me out here. What's it going to do to your cost of capital if you keep pushing numbers into your debt? You'll actually push your cost of capital down. That's not conservative. So the cost of capital calculation, be narrow in your definition. So use that cost of capital, you come up with the value of the business. Now you come to a second place where debt comes in play, which is what do I subtract out from that value to get the value back? Remember, you're the equity investor. This is your last chance to deal with anything that worries you. So in addition to the debt that you had in your cost of capital, if you have underfunded pension obligations, you have to come up with that money at some point in time. Yeah, unless you get the government to pick it up. So when you get from the value of the firm to debt, you might use a more expensive definition of debt where you bring in things you did not include as debt in your cost of capital, but things you worry about as an equity investor. And here's something that, at least in the US, is on the radar for pretty much every company, which is you're going to get sued. It's almost a question of, not a question of when, it's not a question of whether, it's always a question of when. So let's say you're the target of a lawsuit. It's a big class action lawsuit. Right now, the lawsuit is too fuzzy. There's nothing on your balance sheet that shows that you're exposed. But as an equity investor, should you worry about losing? Absolutely. So let's say in the lawsuit, you could lose $1 billion, and there's a 10% chance you could lose the lawsuit. That's pure probability. The expected value of that lawsuit is minus 100 million. You've got to subtract it out to get to the value of your equity. That sounds like a strange thing to do, but what do you think tobacco company investors have been doing for the last 30 years? They've been valuing tobacco companies and having to bring in this expectation that some of their value is going to go away because of lawsuits. In fact, the day that Congress actually decided to create damages for tobacco companies, stock prices went up because those damages were created in return for taking the lawsuits off the table. Pharmaceutical companies, the longest, I think from 2007 through 2013, Merck's value was way down because of the Vioxx lawsuits. So when you have a lawsuit out there, you've got to factor in you say, how the heck am I going to come up with a chance that I will lose the lawsuit? Get some friends at the law school. Let's face it, this is nothing to do with economics. I find this the entire process by which you end up paying in lawsuits to be so convoluted. Because it's not just one suit where you win or lose, right? You got appeals process and appeals of appeals and appeals of it. I remember about 15 years ago, I'm in my office, 3 students from the law school show up. And said, aren't you in the wrong building? That time you didn't need an ID, you could come into any building. So they walked. They said, we're in our final year of law school, we don't want to be lawyers. I said, go talk to the dean. You got an existential problem. What am I going to do? They said, we want to go into investing. Do you think I said, yeah, but maybe you should play to your niche here. And I suggested them that they create a business built entirely around lawsuits. There's an investment business here, right? So here's what you do. You basically pick companies that have been targeted in lawsuits and you focus entirely on the legal aspect. Forget about cash flows and let other people deal with that. You could make a ton of money in those businesses because you're a little better at assessing how much, because otherwise in markets, you just swing around. You win a lawsuit, your stock price goes up, you lose a lawsuit, it collapses, and it can be a huge number. Bayer, you remember the German pharmaceutical company, bought a company called Monsanto, about 6, 7, maybe more than that, huge acquisition. At that time, they had all these strategic reasons for buying it. But when they bought Monsanto, they bought themselves a huge legal problem. The legal problem was, what did Monsanto bring into Bayer? That for the next 5 years weighed Bayer down. Lawsuits on a product called Roundup, which is pretty much every lawn in the US was treated with Roundup, and Roundup was causing cancer. So this is a class action lawsuit to end all because everybody potentially. It started with landscapers saying we're getting cancer, but basically millions of people could, your kids rolled in the grass. I think that pain lasted 5 years. Eventually, the only way they did it was they paid a preemptive $1 billion, $1.5 billion to make it go away. This is not a small issue. It can be an issue that drains your value. And if you're investing in a company when this is a worry, you've got to bring it in explicitly when you value it. So when you think about what you should subtract out, be expansive in your definition of your lawsuits, you might have to bring them into the. And if you have things like underfunded pension obligations, legal obligations, they might not be part of debt when you do cost of capital, but you should be incorporating them when you think about how do I come up with the value of equity in a company? Any questions on so basically 2 rules on debt. Cost of capital, be narrow in your definition. When you think about what do I subtract out, you can bring in issues that you worry about, including regulatory costs you face, expected legal, all the things that you think you have to end up paying as an equity investor. Which brings us to the final topic for today, which is increasingly, as I've said, companies pay their employees with equity. And it's I just finished my post on dividends and buybacks, which is my last data update post for 2023. And if you last year, I think Congress, as part of the Inflation Reduction Act, created this 1% tax you have to pay as a company if you do buybacks. Because senators don't like buybacks. I think it's a terrible thing. They want to discourage companies from buying back stock. It's a kettle of fish I don't want to open up. But Congress often passes laws against something that they think is undesirable behavior. So the early 1990s, Congress was worried about the fact that CEOs were making too much money. So if you think this is some new phenomenon they noticed 2 years, this has been around a long time. So in 92, Congress, in its wisdom, decided to pass a law limiting how much CEOs could make. This is good. But that law was written in terms of pay and bonuses because that's how managers got paid. So the law gets passed with a cap on how much a company can pay and how much they can pay in bonuses. But what it completely ignored, because they didn't exist, was things like management options. So guess what happened over the next decade? Pay went crazy because companies decided to pass out options, and aided and abetted by accountants telling you that when you give an option which is at the money you're giving away nothing, they gave away tens of millions of options. Law of unintended consequences. Right? So if you look at the starting point for employees being paid with equity, it's the fact that companies increasingly realized they could get around the law by using options or restricted stock. And that's continued. It's actually become a big part of compensation packages. So let's take the options part because that came first, and let's think about how to deal with options. And we'll talk about restricted stock and talk about why companies have moved away increasingly from options into restricted stock. You know what restricted stock is, right? You get shares in the company. What's the restriction that those shares come with when you go to a company? You cannot sell them for a period, 3 years, 5 years. There's a vesting period first before you get the option, then you got to wait. So the restriction is on liquidity. Restricted stock are far easier to work with in valuation than options. I'll talk about why. Options are a bit of a mess. So what I'm going to do is actually to set up the process is to think about first, what has been done in the past. So let's start with restricted stock, right? Because they're easy to deal with. I'm a company, I pay my employees with restricted stock. Remember we said you do this because you don't have the cash? It's a compensation expense. What do we do with all of the compensation expenses? We treat them as part of cost of goods sold, we reduce our revenues by it, and we come up with lower earnings. So you get restricted stock, it's going to lower your earnings. And don't give me that crap about it being non-cash. I don't care. You skipped a step. You'd issued the shares to the public, taken the cash and paid it. So restricted stock are going to reduce your earnings. Your share count is now going to go up, right? Because you have restricted shares outstanding. So in evaluation, if you do things right and include the restricted stock as part of your share count, and you use the earnings that are after, which are, right now is how earnings are calculated. Restricted stock take care of themselves. So don't ignore restricted stock. They're always in the footnotes, but bring them in as part of the share count. Saying what's so different about options? To understand what the issues that come with options, let's think of a very simplistic and simple reason why options affect your value. Options affect your value because you give the right to somebody to buy shares at a fixed price. In other words, when they exercise it, they're going to buy the shares at a discount in your market price. That's really the problem with options. Is not just that you're giving managers a right to buy shares, but the right to buy shares at a fixed price, and they're going to exercise right when the stock price goes up. So with options, the question always has been, how do you bring in that expectation? Because even though the options are usually granted at the money, it's really about what will happen in the future. So I'll take you through 3 ways in which people deal with options in valuation. And as you go through with each, I'll talk about what the limitations of each one are and why it might lead you to the wrong place. So I'm going to set up a simple example because I think that the best way to do this is actually with the simple example. So let's assume that you have a firm, you value the firm. Let's say the value of the firm is 2 billion, you got debt of $1 billion, come up with a value of equity of 1 billion. I'm sorry, this is the example. You have 100 million shares, billion divided by 100 million gives you a value per share of $10. I issue options at the money options. And this is exactly the example that I did, 10 million options at the money. And I asked you a question, will it leave my shares unaffected? And I think we kind of agreed, at least I pushed you into this consensus that when these options get granted, you're going to feel poorer after it. Your value per share will go down. So I'll give you the 3 ways in which people deal with options, and you can tell me which one of the 3 you would prefer. The first is what I call the bludgeon approach. The bludgeon approach is what you do. You take that $1 billion you had in value of equity, but instead of dividing by the actual number of shares, it's called primary shares outstanding, you divide by what's called diluted shares. What you do is you take into account the 10 million shares that will come due when the option, we act like they're already out there. So you keep the value of the equity at $1 billion, you divide by 110 million shares rather than 100 million shares, you get a value of $9.09. I think you've undervalued a company for a very simple reason. What am I missing when I use the bludgeon? Half of all analysts probably use the bludgeon approach, maybe a higher percentage. They use diluted shares. I've taken care of options. What am I missing when I use the diluted approach? When these options get exercised, what happens? Managers come in and say, I want to exercise my option. They get a share, but in return, what do they have to pay? They have to pay $10, right? You're missing that entire $100 million that's going to come in by leaving the numerator at $1 billion. So the fully diluted approach, you're counting all the bad stuff. My share count is going to go up, but you're not bringing in the fact that there's going to be 100 million coming to the firm. You're going to undervalue the shares. So when people say I've used the fully diluted approach to deal with options, you really aren't dealing with options. You're doing basically adjusting the count and leaving everything else unchanged. Is there a simple fix to that? Add 100 million to the numerator. That's called the treasury stock approach. In the treasury stock approach, here's what you do. You take the billion in equity value, add the 100 million you get from the exercise proceeds, and you divide by 110 million shares, and you get accounting magic, which is you're okay, you're unaffected. And you can see why, right? When I add the 100 million to my numerator and adjust the share count by 10 million, I'm acting like you're going to exercise the shares today when the exercise value is basically zero, which you wouldn't do. And of course, I'm going to overvalue the shares. So the bludgeon approach undervalues the shares. The treasury stock approach will overvalue the shares because essentially I'm ignoring the time premium on the option. Remember, when you did option pricing, there's a time premium on option. I'm acting like the time premium is zero. So the bludgeon approach is screwed up because it doesn't count the exercise proceeds. The treasury stock approach is screwed up because it doesn't consider the time premium. So I'm kind of pushing into the third approach. So what do I need to do? I need to bring the time premium in, right? How the heck am I going to do that? What is an option pricing model? Forget about the mechanics. What am I doing with an option pricing model? I'm basically getting an expected value for the option across all stock prices, right? That's what a Black-Scholes binomial, no matter what the model is, you're saying, look, I don't know what will happen in the future, but I'm going to value the option, the assumption that prices can go to lots of different points. The option gives me downside protection. I'm not required to buy if the shares go below 10, but if the shares go to 15, 20, 25. So an option pricing approach brings in the time premium into the value of the option. So the third approach is what I do. Rather than adjusting the share count or adjusting exercise proceeds, I first value the firm and value the equity like I would have normally done. Then I value the options. What does that mean? Take the 10 million options which are at the money, look at their time, time to expiration. I mean, we know if you've seen option pricing models, you give me the parameters, I can come up with the value of the option. And those options are not going to be worth zero, because there's time left in the option. I might come up with 3 million, 7 million, 15 million. I'm going to subtract the value of the options from my equity value. Let me repeat that again. I'm going to take the $1 billion that I had as value, subtract out the value of the options, and then divide by the primary shares outstanding. So rather than adjust the share count, I'm adjusting the value of the equity by the value of the options outstanding. I know it sounds incredibly messy, but actually option pricing models are among the easier valuation models because there are very few parameters that are in your control, right? The S, the K, the T, the R, the sigma, they're all given, so they might be wrong. It's actually one of the easier valuations, but that becomes the key to this process, valuing the options. So when I first brought this up 30 years ago, the accounting argument is too complex. People won't understand it. So that's why at that time, options were not expensed, existing options were just added to the share count. But it's always been the case that you can value options. But I'll give you the caveats. Option pricing models, the Black-Scholes, the binomial, were designed to value listed options on the Chicago Board of Options. You're saying, so what? The typical life of those options was 3 months, 6 months. So they're designed to value short-term options. And when you exercise an option on, that you get on the Chicago Board of Options, the company has nothing to do with it. It's between you and someone. So it doesn't affect the share count. Employee options are different. First, a typical employee option is 5 to 10 year maturity. So it's not short term. So the assumption you make about variance not changing, which is part of an option pricing model, becomes stretched. But there's a second problem, which is when employee options get exercised, you actually affect the share count. There is an effect. There's a dilution effect. Now, the way this plays out is, let's say the stock is trading at $10.15 and your exercise price is 10, and you have 10 million options, you decide to exercise. You know what's going to happen the second you announce you're going to exercise them? The $10.15 is going to become $9.75 because people are going to factor in the dilution factor. So we need an option pricing model that can deal with long-term options and also deals with this problem of early exercise. That there's also a third problem, which is traditional option pricing models assume that if you're in the money and your options never get exercised before expiration on the city bill, because you always sell it to somebody else. You get a time premium. Why do you exercise? The problem with employee options is they're not tradable. You work at Apple, you got 2 million options in Apple, you think the stock prices that are high, you can't sell those options. So you know what's going to happen. When you have employees who think the stock price is peak, you're going to get people exercising on an option earlier than the maturity date, saying, I'm going to cash in. Tesla is at $1,200 per share. This is about as high as it's going to go. In fact, there were a lot of option exercise that occurred around $1,000 per share for Tesla because a lot of employees wanted to cash in. Good for them that they did. So here are the three problems. They're long term, they get exercised early, and there's a dilution effect. And that was the argument. A lot of people said you can't, but that's not a good argument, right? Because you can adapt option pricing models. And that's what I'm going to do. I'm going to take traditional option pricing models and I'm going to adapt them to do what? Adapt them to more longer term options, which means my variance estimates have to be better. Adapt them for dilution, which means my stock price will be a shifting target. It won't be the actual stock price, but stock price adjusted for dilution. And adjust them for the fact that these options might be exercised well before maturity. I won't go into the details because it's almost to the end of the class, but we can do it. In fact, accountants now do it with traditional option grants. Now they have to be treated as expenses. Starting in 2007, companies which grant options to employees have to treat them as expenses in the same year. You didn't get the free lunch you got after that, which is if you give options, we won't worry about it, that's gone. So guess why companies have shifted to restricted stock? Once you took away that freebie reason for issuing options, companies said, no, maybe I shouldn't issue options. We'll go with restricted stock. They're easier to manage. So thank God for that. I'm glad that we've shifted away from options, but there are still some companies out there like Cisco that are big grantors of options. So next session, when we start, we're going to use an option pricing model to value the options and bring it in. But we're also going to talk about what about option grants in the future. This takes care of options in the past. But what if I expect my company to keep doing this for the next 5 years, next 10 years? How do we bring it in? So I will see you after the break. I will send you an email today. I'll send you an email tomorrow. I will send you an email on Friday, but then you get a week off. I promise you, you will not hear from me. But 1 week from Friday, I will be back. I'll be back.